Hello, my name is Sarah Palmer, National Key Account Manager and Buy-to-Let Lead at Santander for Intermediaries. We have three main areas to look at today: the buy-to-let market, EPC regulation, the retention market and opportunities that lie there, and then I'll finally finish with why choose Santander for Intermediaries for your buy-to-let business. So firstly, I'll focus on Santander and our place in the market. We have made significant progress over the last 5 years. In 2020, we grew by 6% in completions, whilst the market reduced by 12%. And in particular, 2021 so far is showing huge growth. We have seen over £5 billion in applications received so far, and completions have well exceeded last year's 2.6 billion. This really demonstrates how well we have now positioned ourselves within this market and how well our proposition has now embedded. We ended 2020 as the 5th largest lender, but going by our predicted output for this year, I'm going to be bold and predict we will finish the year moving further up the ranking. Looking at the wider market, the upward trend in buy-to-let, which started in Q4 2020, has continued through 2021. After a strong recovery in the second half of the year, 2020 ended with an outturn of 38.1 billion, down just 12% on 2019, which, considering how the market came to a standstill for a period of time, is quite staggering. Buy-to-let lending to August 2021 was 30 billion in completions, up by 22% in the same period in 2020, with the full year now forecast to be circa around 42 billion. The impact of the stamp duty concession was evident in landlords' purchase behaviours, which drove a shift in business mix from 25% to 42% for the first half of 2021. The increase in purchase activity was not just stimulated by the stamp duty concession, which landlords obviously benefited from, but also the change in lifestyle habits since the pandemic. This has not just stimulated the residential market, but buy-to-let too, as tenants have looked for more rural properties, larger gardens, or properties with gardens, and office space, for example. As you can see from the top right chart here, intermediaries continue to dominate the buy-to-let market. We ourselves only offer buy-to-let mortgages via our intermediary channel. Buy-to-let landlords want and need advice. Monthly completions show two distinct peaks in March and June, which correspond with the stamp duty concession, and the overall market, which has seen the biggest mortgage approval volumes since 2007. At Santander, we ourselves saw a shift from 15% purchase in early 2020 to over 50% at peak. This was higher than the market purchase mix, meaning this has not just necessarily been professional landlords' activity. The reason I say that is professional landlords is not necessarily the space we operate in. There is evidence that smaller landlords have taken advantage of the opportunity with either buying their first investment property or expanding a small number, which would account for our increase. Our policy fits really well with this type of customer. Among those multi-property landlords, 43% have invested in properties outside major cities, with 82% of those who have done this saying they still expect a significant number of renters still to move out of cities due to the pandemic and a continued trend towards remote working. So what's happening with rents? Recent data from Rightmove shows many city centres saw double-digit price growth in the third quarter of this year. Specifically looking at regions, since February 2020, i.e. pre-pandemic, renters in Bristol faced a 12% rise in their bills, Nottingham and Glasgow had an 11% rise, and Birmingham saw a 10% rise in average rent prices. In Edinburgh, however, rent dropped 5% across the same time period, and in Coventry, rents fell by 2%. Meanwhile, rental prices in London grew by 2.7%. The first annual rise since before the pandemic started, according to Rightmove. This means that annually, and excluding London, city centre rent prices have grown by 8.6% on an annual basis, the most rapid acceleration Rightmove has on record. The firm also shows that demand for rented properties remains. The rental properties overall up 39% on 2019 and up by 11% compared to September 2020. Landlords will know that demand for rented property remains. The Office for National Statistics forecasts 1.6 million additional households in England by 2028. A significant number of these will be rented. So if landlords can provide high quality homes meeting the needs of tenants, then people will want to rent them. Plus, if a landlord has cash, what else will they do with it? Property is still seen as a good investment. This is proven where at the start of the COVID crisis, there was talk of house prices reducing by up to 9% in some reports, but what we actually saw was an annual growth of 7.6%. So coming on to EPC regulation, this is a subject I'm very passionate about. It's a hot topic at the moment. It's to do with the proposed changing regulation for landlords. So my question is, do all landlords understand the impacts? In summary, all new tenancies from the 1st of April 2025 and all existing tenancies by the 1st of April 2028 must meet an EPC rating of C or higher. This seems a way off, but time goes quickly as we know, and it will soon be upon us. The main challenges identified at the UK Finance main conference were how lenders can support this regulatory change given the quality of the existing stock, with around 62% of private rented properties rated D or below. As lenders, we need to understand the shape of our individual books and how it will help over the next few years. You will have seen lenders launching more and more green products, and no doubt others will follow. We have a green team who are currently analysing our book and our future actions. We have seen that COVID has increased the popularity of family-sized homes in more suburban areas, which includes older properties, which means potentially both are more costly for landlords to upgrade. In fact, some older properties may have to be exempt due to the cost required and the proposed £10,000 cap on spend for the improvements needed. A recent survey carried out by lettingaproperty.com found that 98% of renters would prefer to live in an energy efficient home and 52% would be willing to pay an extra 10% in order to do so. A third of renters would accept a 5% rent increase, while 8% would be willing to pay an extra 20% if it meant they could rent a greener home. A vast majority of the renters, around 85%, were happy to consider a so-called green lease, which includes clauses designed to ensure the tenant and landlord work together to improve the home's energy efficiency, whilst reducing costs and environmental impact. This is a conversation that must be had with landlords when arranging mortgages to ensure they understand the landscape of EPC regulation. Moving on to the product transfer market. If we look at 2020, remortgage was 26.3 billion for buy-to-let, of which 92% was via intermediaries and 8% via direct. Product switches was around 30 to 35 billion. So if you put those two together, that gives a market opportunity of around 70 billion. We know this year we're in a bumpy year for buy-to-let remortgaging and product switching due to the spike in business we had in 2016. If you remember the changes to stamp duty tax for landlords, there was a huge spike in business, which mostly or over 50% was placed on 5-year fixed rate. So obviously this year they've all been rolling off. So of that 30 to 35 billion in product transfer, we know 60% was via intermediaries. So this shows there is more opportunity for you, the intermediary, to offer these product transfers. Our own stats show a large percentage of brokers do not check the customer's product transfer rate on our system. Our products do not show on sourcing as they're tailored to each customer. So you have to view them on the PT system in order to know what the rate is and to go ahead and arrange it if it's best for the customer. So the fact we can see a lot of them aren't looked at, we know and we still do retain customers, means we know that brokers are missing out on the opportunity. We are happy to retain a customer anyway, because our goal is to keep the customer, but we do give you the tools to do it. So ensure you're checking rates 4 months prior and switching at 4 months prior if the rate is lower, which 9 times out of 10 it will be, because that's what's best for the customer, and you can start saving them money 4 months prior to their maturity. In terms of remortgage, we've also seen an increase in house prices. So as the purchase boom slows down, we've seen and expect to see more remortgage boom, more capital raise for home improvements, further buy-to-let purchases, or even debt consolidation in some cases. So big opportunity on product transfer, big opportunity on remortgage. We know that the next biggest month for maturities in the market is January 2022. So you would need to have been on top of those customers already. So please ensure you've done that. So coming on to Santander for intermediaries and why choose us for buy-to-let business. Some important criteria to know when placing with us. A key point to note for first-time buyers is that at least one applicant must be an owner-occupier. So you can have a first-time buyer, but there must be another applicant on the application who is an owner-occupier. It's one of our biggest reasons for decline is where the application doesn't meet that policy. So I always like to highlight that point. We do have really good criteria on ASTs, for example, where we allow up to 4 individual named parties on the AST and up to a period of 36 months, which is really good to know, particularly for things like student lets, where, as I say, you can have 4 and we can go up to 3 years. Please remember, though, we do not lend on HMOs or properties with more than 6 bedrooms. At least one applicant must have a minimum income of 25,000, and that is excluding rental income. But I say that's at least one applicant. So you can mix and match the criteria here. So you can have one applicant who meets the 25,000 minimum income and one applicant who meets the owner-occupier policy. So that's how it works. Mortgages up to 75% loan to value, and don't forget it's free standard valuation on our products and also free standard legal fees or £250 cashback on remortgages. How much could your clients borrow? So we have simple grid here that shows for lower rate tax band payers, we have a calculation rental cover of 130%, and where they are higher than 20% taxpayer, is 145. We have for affordability all 5-year fixed rates at 4%, any other products at 5.5%, unless you're remortgaging without capital raising, and then it's 4% across the board. So really, really strong affordability rate there for, particularly in remortgages pound for pound and for 5-year fixed rates. In terms of the number of properties the applicant can own on completion, for purchases and remortgage applications where there's capital raise, it is a maximum of 3 mortgaged let properties with any lender, and that's where we don't play in the professional landlord space. They can have a maximum 10 properties, but only 3 can be mortgaged. However, for remortgage with no capital raising, we will allow 3 properties with Santander and 10 mortgaged and mortgage-free properties in total. So more generous, and there we will lend to professional landlords in that space. It's so important to use the calculator as you are checking the application fits the customer's needs. It's very, very simple to complete. It will only take you a few minutes and it could save a lot of time further down the line. Points to note, we do not require income documents in most cases. You must have them on file, and obviously you must have checked the suitability and that it fits policy, but we don't require the documentation. We also do not require a portfolio spreadsheet. The aggregate lending will be entered on the FMA. We carry out automated valuation models, so AVMs, on all buy-to-let remortgages, and around 25% I would say pass. We have seen some buy-to-let offers same day. So please ensure you've done the work up front to give it the best chance, and therefore the calculator is really, really key. It will give you two outputs. If you put in for a 2-year, it will give you the loan amount available as it shows on this screen. What it will also do is show you what the loan amount would be should you take a 5-year fixed, because clearly the affordability differs in that space. So you don't have to go back and start again, you get the two choices on the one screen. But please ensure you do this. And coming back to the AVM, just some tips there. About 25% passes AVM. And for the best chance, you just need to make sure that the property information is 100% accurate, because the AVM will fail if there's the slightest difference. Also, the rental amount must match what our automated systems are telling us. And if that doesn't, there is a tolerance in there, but if it's outside of the tolerance, then it will fail for that reason also. So to summarise why choose us for your buy-to-let business, we have their maximum 40-year term, brilliant affordability rate of 4%. We use the lower tax band on a joint application. So if I go back to how we had 130 and 145% ICR calculations, if you've got one lower rate taxpayer and one higher rate taxpayer, we will take the lower rate taxpayer and apply the 130% ICR. And that does differ to a lot of our buy-to-let competitors. So do remember that USP. We go up to an age of 85. We will do capital raise for personal use up to 75% loan to value, including debt consolidation. Again, I stress that one because lots of our competitors do not allow debt consolidation on buy-to-let, or certainly not up to 75% loan to value. So it's a real USP for us. And as I mentioned earlier, you've got their 4 named individuals and a single tenancy, and that tenancy can be up to 36 months. We also, in addition to these points, allow occupancy within 3 months. So I would say a lot of other lenders require immediate occupancy at completion. We just ask that the property is habitable, i.e. working kitchen and bathroom. On our residential products, we require a minimum of 2 years self-employed. On buy-to-let, this is only 1 year. And I do find still a lot of people aren't quite aware of that policy, because it's thought that it's the same as on resi, but it's not, it's just 1 year. On studio flats, we don't have a minimum square footage. Again, most lenders do, so definitely one to remember. We find that's really popular in city centres and university towns. So it's really useful to know, again, for those student lets, but also just for city centres. We ask the valuer to tell us whether the property is suitable for lending. So as long as the valuer is happy with that studio flat, it doesn't matter what the square footage is. And again, I go back to the fact that our valuations are free. So even if you weren't entirely sure, the customer isn't going to lose out by having that valuation done. They've got nothing to pay for that. As mentioned before, simple and fast application process, no paperwork. AVM done on every remortgage. They don't all pass, I must always caveat that. And remember, we can produce offers very, very quickly if there are no questions asked. So lots of good reasons to consider Santander for your next buy-to-let application. I hope you found that really useful. Thank you very much for listening.